Welcome to My Money, Your Money, a talk show on generational wealth, wealth management, and personal finance. Now introducing our host, Miss Brigette Lumpkins.
Hello, beautiful people, and welcome to My Money, Your Money, brought to you by our generous sponsor, Demesman and Dover Accident Attorneys. I'm your host, Brigette Lumpkins, and I earned an MBA from Wharton and have worked at firms such as Goldman Sachs, Lehman Brothers, and Barclays, serving institutional and private clients and raising capital for investment funds. Currently, I'm an executive at a crypto asset management firm in Miami. I would like to welcome our guest, Eric Pettus. He is the president and founder of Pettus Dawkins Financial Group, PDFG. Prior to establishing PDFG, Mr. Pettus was the owner of an Ameriprise Financial Services franchise. He was with the company formerly known as American Express Financial Advisors for several years, where he earned several awards for providing superior levels of financial planning and client service. He enjoyed a career in retail prior to that, where he supervised loss prevention departments at Wackenhut Corporation, Caldor Incorporated, Eckerd Drug, VisionWorks, CarMax, First North American National Bank, and Circuit City. That's part of what we're going to dig into today, actually. He's also consulted with numerous small businesses, which really led to his calling of becoming a financial advisor and educator in financial management. He's a graduate of Towson University. Eric, welcome, and thank you so much for joining us.
Thank you. It's always a pleasure to be in the company of greatness, and I'm looking forward to having an opportunity to participate in your program because, again, money matters, and generational wealth creation is very important to our legacies as well as our futures.
Right. That's right. And this show is all about various ways that we can reduce that wealth gap. So I know I gave a sort of brief intro, but can you tell us a little bit more about yourself and what you're passionate about?
Wow. So I would say passionate. I am passionate about helping people. When I got into the financial services world, I realized that there was a segment of the population I call the lied to, cheated, stolen from, and ignored.
Mm-hmm.
And generally, people that look like us fall into that category.
Right.
Particularly the ignored and the and oftentimes lied to and cheated. Okay. So when I got into the industry, I felt that my role, much like the book The Spook That Sat by the Door, was to be able to be in the business, to be able to teach the folks that are not in the business how the business truly works, and how to give folks that look like us the opportunity to win in the game of investments in financial services, as opposed to the historical structure of the industry, where people that look like us have been exploited in the industry. So that's really what my mission was, and continues to be, helping folks that to understand how this business works and how to take the best advantage of it for themselves and according to what their goals are. So that's other things. I'm from Pittsburgh, Pennsylvania originally. Through my corporate background and experience, was moved to Florida, left, went to cold climates, and realized that there was nothing better than the warmth of South Florida. So I was able to orchestrate a return to South Florida, and just upon reaching what I call the corporate glass ceiling, I decided to go into business for myself. As you said earlier in my bio, I worked with some major corporations, but more than just working for those companies, the good part about my career was, prior to the age of 30, I did all those things, but I was able to fortunately work for companies that were different transitions that helped me to be able to help others. For example, CarMax when Circuit City started CarMax, and grew that business, and then did a spinoff of the company, and had it do an initial public offering. So I was involved in a spinoff from a company. Eckerd Drug purchased VisionWorks, which was an acquisition, and then VisionWorks was a leveraged buyout by employees. And then Eckerd was a privately held company that went public. Then later on, Eckerd was purchased by JCPenney, which was a merger with the stock split. So I got involved in all these different kinds of transactions.
Did you get any equity in all those transactions?
And some of them I did.
Okay, that's good.
I was high enough in the company to have the stock grants and bonuses and stock options and things like that. At one point, I was at Circuit City, I was one of 3 people that looked like us. We were kind of tied for the highest ranking Black folks in the company. And that was at a time when the company was actually going through a class action lawsuit for racial discrimination. So I've been part of those kind of situations where it didn't really affect me because I was at a higher level, but I was able to participate in giving my 2 cents of experience and evidence to help those folks that were in that lawsuit to be able to win that lawsuit.
Well, that's you bring up a really interesting point when you talk about this sort of string of transactions throughout the companies where you've been involved. And I think that we can segregate that for like a whole nother topic, which is investment banking and M&A, mergers and acquisitions and financial transactions. That is such an important part of how our financial system works and how wealth is created and destroyed that we often don't have access to, right? Because we're left to decide. And you clearly have a profound understanding of this. But when we were talking on background, what most intrigues me about your background is the stolen from part of this group of people that you have organized. And in your background in loss prevention, you've leveraged that. You've sort of merged that background in loss prevention with your knowledge of financial management. And you have created a unique franchise in forensic accounting or forensic sort of financial investigations and auditing. So I would really like to know a little bit more about that and really how it relates to the average person and how they can protect themselves against some of the things that you see happening when you do a case. So you can do that however you want. If you want to walk us through something sort of a typical scenario, or just give us a bit more background on the kind of things you do, and then talk about how that affects average people.
Right. Okay. So I'll start with average people because, again, I'll assume that most people that are looking at this are going to be just regular folks that are trying to get knowledge and information on how financial matters work. One of probably the biggest areas of that we come across is that there's a propensity in the financial industry where, let's say that a person has a mutual fund portfolio and they are invested in these mutual funds. Well, one of the things that is taught in the financial industry that is very often overlooked is that financial people will, let's say that a person has $40 million that they manage with all of their clients, right? And let's say that you have $400,000 invested with that advisor. Okay. Well, in order for advisors to continue their income stream, they are taught to rebalance the portfolio of all of their clients on an annual basis, right? Mm-hmm. So how they do that is they say, okay, you've got $400,000. I've made commission on that $400, but next year, what I'm going to do is rebalance your portfolio. So I'm going to take that 400, I'm going to break it down into quarters. I'm going to take $100,000 and I'm going to sell whatever that money's in. So now I've sold it. Then I'm going to go back and turn that and reinvest that 100,000, and now I get a commission again, right?
So churning.
So
churning.
It's not churning, because churning is repeatedly doing it. But if they only do it once a year,
that's not churning.
Nobody knows.
Okay. Right. Okay.
So from the legal standpoint of churning, it's not as easily noticed.
Okay.
So now how I catch people doing that is I look at what you had it in, and then I look at what they bought. I look at what it sold for when you sold, and then what you bought again. I've found advisors that will actually sell when the fund is down. They will sell that fund and then turn around and buy that same exact fund again a month later when it's high.
So, this isn't just for, this isn't just for harvesting losses for tax purposes.
No, generally it's to give that advisor an income stream. So imagine if that advisor's got $40 million that he's managing, if every year he converts $10 million of clients' assets and sells it and reinvests it and gets another commission, that advisor is going to end up creating an income stream where if he's getting 6% a year or on those trades, he's going to get $600,000 a year every year, because he's rotating 25% of everybody's money every year. Okay. Yeah. No rhyme or reason to it other than it's generating commission.
Right.
So you catch that all the time. Okay. You as the person says, oh, my advisor's rebalancing my portfolio for me. I've got to rebalance every year. You're thinking that this is something that's good for you. But if you don't pay attention to what that person's selling and what that person's buying, you end up in a position where you might be losing money while that person's making commission.
So who calls you to make this investigation? Because if I'm the client, maybe I don't even know that this is happening, right?
Exactly. Generally, what happens is people will want me to look at what they already have.
Okay.
And how that happens can be various reasons. They just may talk to a friend, and the friend says, hey, my portfolio is doing this, their portfolio is doing worse. And they'll end up referring me to that person. And then I'll go and I'll get their statements and I'll look at it. And then there's certain things that I'm looking for. I'm looking for, well, why is this underperforming? What's it invested in? And then as I go and look at the history, I'm able to a lot of times see that this person bought something and then rebought it days later, month later. And it's like, why did they sell it if they were going to buy it back? Now, selling out of something that's not doing well, that makes sense, but you buy something else.
Right. Not the same thing.
You're not going to go buy the same thing.
Not the same thing.
So generally, now there may be a need if you're playing the stock market and the stock goes up and you sell it, you make the money, it goes back down and you buy it, but you wouldn't sell it when it's down to buy it when it's back up.
Right.
Okay. So we catch those kinds of things. Other areas that, when it comes to bigger cases in professional athletes and things like that, I'm kind of not most well known for the Terrell Owens, what we call the Terrell Owens case. When Terrell Owens on TV crying years ago that he lost his money, we're the people that figured out that his financial advisor stole his money as well as about 60 other NFL players' money.
Now, tell me something more about that, right? Because obviously some of our listeners aren't just average income. They have higher income than that, but that doesn't necessarily mean they have the education to protect themselves from this kind of thing happening. So what kind of tricks do advisors use to steal money when big numbers are involved? Because I see what you're saying, where they're basically generating useless commissions for their own benefit. Well, but a lot of advisors are now on a fee basis, and they're just charged a fee on your assets, and commissions are kind of fading, especially in the U.S., as a form of compensation for financial advisors. So I'd imagine that you're going to see less and less of that as time goes on. What kind of clever tricks did Terrell Owens' person use, or were they even clever? And the client just wasn't being vigilant enough, paying attention to have caught their not so clever scheme.
Well, I would say the first thing is that in that particular case, it was almost like a group of individuals sat around the table and said, how many things can we come up with to take these people's money? Okay.
Oh, wow.
All right. So it was that brazen. Now, for example, one way when you mentioned about fee-based, well, if the more money you have invested, the lower the fee generally is, right? Well, I've seen financial statements of athletes where they may have $5 million invested and they're paying 4%.
No way.
Management.
No way. Can you give us some context like that? I had a reaction to that because I used to be an advisor at Goldman, and I know the kind of fees we would charge on a portfolio, the minimum of which would be $10 million. Mm-hmm. And we're talking 75 bips for the whole portfolio. 75 basis points, which is 0.75%.
Yeah,
for
a third of 1%. A third of 1%.
So that's like 5 times that amount. So how does this even happen? Do the managers who refer the people to these advisors, are they in collusion? Are there kickbacks? Is it a whole conspiracy? What's going on there?
Oh yeah, definitely. A lot of times the agent who refers the person's getting a kickback. Okay. And just simply you don't know, because if you never had a $10 million account and you don't know what people are paying, then you think that this person who's told you they're looking out for you is doing you a favor. I've actually seen those types of accounts, and I've told the person you should be paying 0.25% or 0.5% or 1/3 of 1%. And so now, if they trust me to help them out, I'm going to tell them, file a complaint, and in that complaint, they're going to have to disclose what they're charging everyone else. And I can just about guarantee you that the only people that are paying those fees at that rate are people like you.
Right.
Which are generally athletes or people that don't really know. But they're not going to have 100% of their clients at 4%. Okay, right. So you catch that. There's investments where a lot of times athletes get caught because they are pretty much taught that it's prestigious for somebody to take care of your expenses and your bills. I had athletes that were paying their financial advisors $60,000 a year to pay their bills.
For bill pay.
That was the way, hey, we got this money, we're supposed to do it this way. Well, when you start looking and find that the person's paying $400,000 in late fees on their credit card that they use for everything because the advisor is not paying on time. So in order to rack up $400,000 in late fees, you got to think about how much money that person has spent on that card. Somebody was supposedly paying that bill that really wasn't. So now that happens. Other investments. I mean, we had a situation where the player would call the advisor and say, hey, I need $10,000 for my trip this week. And the advisor would say, okay, I'll get so-and-so to bring it over to you. Person thinks they got a concierge service. They can order $10,000 and that's somebody will deliver it to their house, their advisor. The $10,000 shows up, they sign a document. The person goes and takes that document, goes back to the bank, and gets $10,000 from the bank with that player's signature. Well, the player's thinking that was reimbursement because my advisor's got $10,000 petty cash sitting in his office that he can give to me. Well, what really happened was because they gave that advisor discretion over their account, that person went and got the $10,000 from the bank first
and went right back,
signed it, and went back and got another $10,000.
Just double dipping. Double dipping.
Exactly.
That's insane. So is that something that happens with frequency, or is that just the most egregious example?
No, that's frequency. Now, egregious
Wow.
example I would say would be that had a situation where the advisor had the player change all of his addresses to the advisor's office because we're going to do bill pay, so we need to get your bills.
Okay.
So using that document that the player signed to say, change my address to this, the advisor sent that to all the companies that get the bills from. But what they also did was they took a piece of paper and taped above the person's signature and below the person's signature and put that paper in a copy or in a printer and print out a blank paper with that person's signature. And then write whatever they want to write on there and have that person's signature as authorization.
So what are the consequences? So you bust an advisor who's doing this, right? What are the consequences? And is there any recourse for the client?
Well, generally, if the advisor accepts responsibility and pays the money back, they may get a slap on the wrist of, pretty much nothing. It was settled. Okay. That's the biggest. That's the first thing that usually happens. The second thing is that they may get suspended from the financial industry or they may lose their license permanently, but rarely is there any jail time. Okay. In certain cases, which all of those cases I explained would generally be worthy of jail time. But
for sure.
But if you end up settling, then they're out of the woods. And a lot of times the persons that the embarrassment is what keeps a lot of this stuff from getting handled the way it should be and could be handled, because nobody wants to let the world know when they're a high profile person that they
got taken for a sucker.
Exactly.
My goodness. So I'm a layperson, right? I make, let's call it $100,000 a year. I'm finally in a position where I feel like I have a couple of retirement accounts. I'm really starting to cook, like things get momentum with building a financial future for myself. And I want to hire an advisor. How do I make sure that I don't end up at some big wirehouse that's going to charge me excess commissions for unnecessary transactions, or end up with a smaller shop that may or may not do something nefarious, but if anything goes wrong, doesn't have deep pockets to make me whole. Because one of the things, I remember when I was at a big institution, one of the reasons why people would go with Goldman or Morgan Stanley, and I'm sure American Express when you were at Ameriprise, is that, in case of malfeasance or whatever, the organization has deep pockets. And so you feel some sort of confidence that if anything goes wrong, you'll get your money back from somebody. How do you protect yourself as a consumer of this environment?
Well, I guess, first of all, in this industry, we have to have errors and omissions insurance. Okay. So generally, there's insurance to cover any wrongdoing. But the caveat is you have to have an advisor that is a fiduciary, meaning they have an obligation.
Explain what that is.
Fiduciary is one of the most important words in the financial world. And that is that person has a obligation to make recommendations and they're working with or for. So that being said, if you ask that advisor, are you a fiduciary? And they say yes, that means that you have recourse.
So you defined a fiduciary, but what credentials, how does one become a fiduciary? I understand what it is. I mean, of course I understand what it is, but who is a fiduciary? How do you become one? Does it come with a license? Does it come with a certain title? Does it come with a certain set of services that you provide? Well, what distinguishes a fiduciary?
Generally, the person would have to have a 65 license or a 66 license. That's that. However, if that person acknowledges verbally or in writing that they are operating as a fiduciary in your situation or your investment, or in their advising you, then you have recourse as well, because it's not your responsibility to determine whether they're properly licensed and credentialed. It's their responsibility to explain to you what their role is. Okay.
Mhm.
And it's very simple. If you ask, are you a fiduciary? Yes, I am. Follow up with an email to them that says, in our conversation at 5 o'clock on this day, you said that you acknowledged to me that you were going to be operating as a fiduciary in a fiduciarily responsible capacity for the work that we are doing together.
Mm-hmm.
And now you have that. Okay.
Okay. All right. So that helps, and that helps protect you as a consumer in case anything goes wrong. You have that in writing. That person made that claim, and that gives you sort of rights to any recovery if they make a mistake or anything else goes wrong.
Exactly.
That is recoverable, I should
Right.
say. Because lots of things go wrong that are not recoverable, like the whole market crashing. You can't sue your advisor because the market crashed and you lost money.
Well,
So,
yeah, you can't do that. Now, here's the thing, though. In a lot of our cases, people don't know if that person was operating as a fiduciary or not.
right.
So
Okay.
what we generally will do is we will have them email the individual and ask certain questions that only a fiduciary would answer a certain way.
Okay.
Like, I invested in this stock. Is that what I should have been investing in based on my status as retired? What do you think?
Right.
And if that person says, oh, yeah, absolutely, that's a stock you should have invested in, and your retirement status is not an issue. Fiduciary.
Right.
Okay. So if you can ask questions of that person at a later time that they would respond to as fiduciarily responsible person would, then you have them. Now, if they're not operating in a fiduciary standpoint, they should say, well, that was just a stock that I thought was important that you should try to buy, but I wasn't really looking at it from that standpoint.
Okay. Well, this has been so educational so far. You're going to be surprised to hear that we're almost out of time. So I really want to pivot to just a real overview of the services you provide. Sort of, I don't know how much time do you spend on this forensic work where you're really helping people to unwind something that's happened to them, and the rest of your time, I'm sure, I presume you spend on just helping people, giving them advice, acting as a fiduciary, building portfolios, whatever. Can you just tell us a little bit about your business mix,
Right.
and sort of how you can help our audience?
Okay, very good. So generally, prior to COVID, because it's been a little change, but prior to COVID, Pettus Dawkins Financial Group generated the majority of its clients by doing financial education workshops and seminars. Okay. We do churches, unions, corporate associations, homeowners associations, professional associations. We've worked with some organizations such as the National Black Police Association for over 20 plus years. So that's how we generate the majority of our clients. Okay, that and referrals. So that's how we build the client base. The next thing that we do a lot of is, again, the full financial planning process. How much you got coming in, what you got going out, what you got left, what are your goals? How does that overlay into those other three things? How much money do you have to put towards those goals? When do you want to achieve them? Just kind of getting the overall picture of where a person wants to be. Mm-hmm. Then after we have that, then we're going to go through the process of what they should do to reach those goals. And that's when we start the process of selecting different investments and different things like that. Insurances are a big part of a person's financial position and portfolio as well. So we're looking at that. Then we're also, so we're doing that for the overall person. We also do business consulting where we work with businesses. And like I said, some of those acquisition mergers and things like that. I think that more businesses that are owned by minorities need to look at growing those businesses, making them last generationally, even we're definitely not taking enough businesses public. We're not doing enough mergers and acquisitions in our businesses. So those are things that we need to focus more on from a generational standpoint. We also do real estate development consulting. So our model is really to go to folks that have land. We're not into folks that look like us selling their land. We're into leasing the land, maintaining ownership. Don't joint venture, because your joint venture, you're subject to whatever the developer may do. But again, that's a whole nother one of these educational forums that we should do on that. But we do a good amount of that. We also, when it comes to assets, when folks are getting divorced, we come in, we figure out how much they're entitled to based on whether we're working with the person who's getting divorced and has the assets, or the person who's has the smaller amount of assets who's getting divorced. So we do the math, and sometimes we work with both parties. We do the math, figure out how to split the assets. Yes, the only time we won't work with both parties is if we're going to go to a court situation where we've got to testify. We got to be on somebody's side. But sometimes we'll do cases where the people bring us in together in the front end, and then
sort everything out.
Yeah, it's kind of a situation where, why are you going to fight over something that the law says you're not entitled to?
Right,
so
exactly.
First, get the baseline. The baseline is, what are you entitled to get? What are you entitled to give up? And once you know what that is, then you can decide where you fall into that from am I going through with the divorce or not?
Right. So people don't say, I want half, huh?
Well, I always tell them, generally you're entitled to half. So what we determine is what that looks like based on when it was acquired and all of that type of thing.
Right.
And once we know what you're entitled to, like I say, you could fight, but so far, knock on wood, we've not been wrong when we've done our calculations. The only way you're going to get more or less is whether there's an agreement to that. But if you go in front of the judge and it's done properly, it's not very difficult to make sure that the person's going to get or give what they're supposed to.
Well, it sounds like you have quite a diversified business and a lot to offer. Remind us of your website so people can visit and find what they need, because I think a lot of people out there watching and listening today are going to have questions for you. Okay. So what's your website?
So it's www.pdfgi.com. Pettus Dawkins Financial Group Inc.com. PDFGI.com.
Okay. And thank you so much. Oh, wait, here we go. We have a look of it here. That's a nice looking website there. Very well done. Very well done. So it's been a pleasure. I've learned so much. I wish we had more time, because there's so many places we could go with this conversation. But you've been an excellent guest. I appreciate you so much for coming to join us today. And I know our guests do too.
All right. Thank you very much.
You're welcome. And please to join our other show, to watch our other shows sponsored by or hosted by the MIA Media Group. On Mondays, we have The Business of Black Business with Jay Reynolds at 1 p.m. Tuesdays at 7 p.m., My Money, Your Money with myself, Brigette Lumpkins. Wednesday, Soul at 7 p.m. with Nikki Gellin. Thursdays, Lunch with Legacy Leaders at noon with Anne Marie Sorrell and Flavor of South Florida at 7 p.m. with Chef Irie. Thank you so much for joining us, and let's close that gap.